You're listening to The Moose and the Loose, your 10 minutes action-packed financial podcast with your host, Mikey Hu. Hey, what's up, Market Moose? This is Mike from The Moose on the Loose. Happy Moose Day, or should I say Happy Canada Day? So yeah, it is your birthday, dear Canadians. So let's celebrate a little bit. I hope that you have something planned today. On my side, unfortunately, I am working because I'm leaving for vacation like in a few days. So it's all going to be good. There's always a moment for everything. And right now, I am not too disappointed to talk about my some of my favorite. I mean, I made like a top 5 Canadian stocks for Canada Day, but of course, I'm not going to talk about some of my favorites that are based in Quebec because I had that Quebec-based episode last week for the Saint-Jean-Baptiste, notably talking about National Bank and Alimentation Couche-Tard. So today we are talking about 5 other companies that I really like. Ironically, I only hold 2 of those 5, but that's pretty much just because you cannot have all the stocks that you like in your portfolio, right? So we're going to start with those that I have, and then we're going to discover 3 other ideas that you can definitely take a look at. So first one, CCL Industries. This is not going to be a surprise. This is a company that I have purchased at the beginning of 2023 to replace my shares of Enbridge. So no, there's absolutely no link between both of them. I mean, one is a stable pipeline offering a very high yield but struggling with growth, while the other one, CCL Industries, is a material/industrial/consumer because they are doing packaging related products. So if consumer products are selling more, well, they're going to make more money, but their business model is, of course, highly dependent on commodity prices, mostly due for their cost of raw materials. So CCL Industries, doing business across the world, well-diversified in terms of geographic, well-diversified in terms of products as well. They grow by acquisition. They are a low-yield, high-growth type of stocks. The forward P ratio is at 17, which is kind of interesting, especially because they had a pretty solid start in 2024. So the stock is up by more than 20% since the beginning of the year, mostly driven by stronger than expected results. So when the financials are driving the stock price, this is always good news because it's less of a hype, it's less of a how I think this company will do well, but rather, oh, this company is doing well, so let's just buy it. And this is another reason why I really like CCL Industries, a model of stability and dividend growth. So they've been growing their dividend for decades. Another one that is one of my favorite, and the other one that is in one of my portfolio is Canadian Natural Resources, CNQ. So you know me, I'm not a big fan of the energy sector, mostly not because I don't like oil and gas, but I don't like the fact that most of those business models are fully dependent on commodity prices, and they have no control over that. So if the oil or the natural gas price goes up, they are the most amazing business in the world. And if it goes down, well, they are like 1 month away from declaring bankruptcy. Of course, I'm exaggerating on both sides, but you get the idea. They have no control over commodity prices, and it's really hard to make a sustainable and predictable source of cash flow from this type of business. While Canadian Natural Resources is first vertically integrated, and they sit on super high quality asset where they are profitable even if the oil barrel trades around $35. So in a world where we have an oil barrel above 75, it is an amazing business, and it's exactly in the world we are evolving right now. So CNQ generates so much cash flow that they pay down their debts, they buy back their shares, and on top of that, they increase their dividend. So I see that as a very solid business. It's not going to be always growing that fast though. So even though the past few years it has been like surfing a big hype around the energy sector after the pandemic, I don't expect that from CNQ, because if you go back in time, you will realize that CNQ was pretty much dead money besides the dividend for several years. So just have to measure your expectations, maybe lower them a little bit, but you're going to be very happy to have a company that shows almost 30 years of consecutive dividend increases because of the nature of its business model that is a little bit different than most energy stocks. Now, moving into the financial sector for the third pick that I have in high esteem. I discussed this one several times at DSR. It is part of our portfolios for like, I don't know, 7, 8, maybe 10 years. I'm not even sure if we didn't even start our DSR portfolios with Intact in some of them. But anyways, always a company that I've enjoyed. So Intact IFC, a leader in personal and commercial insurance. And what is great about insurance companies is the more they have clients, the more they write premiums, the more they have data, and then the better they can make their premiums, write their contracts, and make even more money going forward because their predictability for the business model gets better with the level of data. And this is exactly what Intact does. So they have one foot in the States through acquisition. They did the same thing in the UK as well. So they are expanding their business model and they still benefit from a very strong base in Canada, which they are the largest insurance by far. Of course, there are some risk, especially attached to natural disasters. So you just hope that they don't run into too many of those. But they've been managing that for several years, and we've been having natural disasters like forever. So it's not like a new thing. They have been able to do it very well, and they now have like a very solid balance sheet. It continues to grow by acquisition. So I really like the overall landscape where Intact is evolving. Another one that people doesn't like know much about, and I even did a podcast on it, TMX Group. The ticker is X.to. It is like the stock exchange for the TSX. So they are operating. They are offering like the listing of stocks, trading, clearing facilities. They are offering also data products, so you can pay them to get more financial information as a subscription base. They are offering IPOs and all of the other products that are trading on the Canadian market. This company is, again, a low yield, high growth stock. The company has been on a tear for several years now. It is actually quite impressive. So if you look at the total return over the past 10 years, the TSX, the Canadian market, went up by about 106, so pretty much like doubled in value, while TMX went up by 321%, and they're still finding ways to grow. So trading at an okay PE ratio, like forward PE ratio around like 24. So you have to pay for quality, but it's not the end of the world, and definitely a pretty solid pick. Speaking of paying for quality, the last one will, make you grin a little bit. You're not going to be in love with the PE ratio because it trades at a forward PE ratio of 63. The average over the past 5 years, though, is at 65. The company shows an amazing dividend triangle with the past 5 years revenue growth rate at 11%, earnings per share at 8.2, and the dividend growth at 13.5. So you can tell that you have to pay a steep price for quality. And this company is Waste Connections, WCN.to. Always the type of business that is really hard to pull the trigger, because if you wait for a pullback, don't be too picky on the type of pullback because it's not going to be a big one. The business is highly recurring, highly predictable, and it is growing high single digit to double digit year after year. It is a model of consistency, and that's pretty much all the reasons why you have to pay for that type of quality. So I'm not saying it's a great buy, I'm not saying it's a deal, but it seems that WCN never goes on sale. It's like buying an iPhone. You're never going to get a brand new iPhone at 50% of the price. They don't offer those types of rebates. As you can see, besides Canadian Natural Resources, all of those companies show the similar profile where they are low yield, high growth stocks with a long dividend growth history. If you're curious about this investing model, investing strategy, and how it compares to focusing on higher yield, I actually did a complete report called Dividend Income for Life, explaining you the difference between those loyal high growth stocks, how they are more stable, stronger, and actually safer than the high yield, especially if you go into retirement. So you can download that Dividend Income for Life guide for free as long as you subscribe to my newsletter, and you can download it at moosemarkets.com/income. So moosemarkets.com/income. You're going to get the guide for free, and you're going to have some pretty interesting ideas similar to the one that we have discussed today. So, all right, Moose, that's enough for today. I hope that you will enjoy Canada Day. We're going to talk again tomorrow. So again, you can download the guide at moosemarkets.com/income. And until then, don't forget to stay invested. Hey, welcome to the disclaimer. If you're listening to The Moose and the Loose, you cannot really expect me to give you buy or sell recommendation or financial advice, right? You're here for fun, you're here for information and some entertainment. But I am not your financial advisor, I am not your broker, so therefore I'm not liable if you're losing money after listening to the podcast. If you're looking for some advice, go see a professional. If not, you can enjoy the show and do your due diligence after it.